Hey everybody, Courtney Smith here with that time you've been waiting for all week for our TradeSmith Video Weekly newsletter. Now, it certainly had an exciting week, but of course the exciting week was made even more exciting by your ability to read this incredible, exciting disclaimer. And you should memorize it. It's got some cool stuff in it. All right, let's get right into it then. So, S&P 500, here we are. The market, we got the plunge-o-rama from the Brexit vote, and now we've got the rally-o-rama right back to where we were before the Brexit vote. It's like it never happened, except, of course, we were stopped out of some positions in the meantime. So what's happened is that we're back up towards the high end of this range that we've been talking about for a couple of months. And I think we're going to stay in that range. Or if we break out to the top side, I don't think it's going to go very far. There's a lot of reasons to believe that this market can't move much higher. And we'll go into those as we go through the presentation. Nonetheless, certainly not a bear market, that's for sure. We're not going to see a bear market. That's a done deal. All right, Dow Jones, pretty much the same picture. But, this is a different picture. This is the NASDAQ here, and you can see it's much, much weaker. We didn't even get back up to where we were the day of Brexit, let alone the highs that we made back in April and early June. And notice that the Brexit collapse broke some pretty big lows that we made back in May. So we don't want to be over in this side of the market. This is not where we want to be. We want to be someplace else. Now, the other thing, though, is that I do think that it's going to continue to move higher. It's going to play a little bit of catch-up. And one of the reasons why is our purple predictor. Take a look at that line. That's the on-balance line, the purple line there. And you can see that it's broken to new highs compared to the highs we made a couple of weeks ago. So that shows that smart money is coming into the NASDAQ and should give it a little bit of catch-up with the other big indices. Let's carry on. Seasonality. Ooh, unbelievable price action here. So when we broke the low at 113, I had moved up my switch level to 113 from 108, which is where it had been for a couple of months. And I think that was the right decision to make because we were making lower lows and lower highs, and so it was a bear market. And we don't want to be long when it's in a bear market. So I think that was the correct decision to make. But notice it plunged all the way down to the 108 level for the third time. That's the red line that I put on there. And then it rebounded sharply. So this thing's about, we're taking a cautious approach because the seasonality is neutral. And I think that's the correct decision to make right here. A break of the 117 high that we made a week ago would modify that a bit. And I'd start to be thinking about maybe increasing the risk a little bit. But for now, I'm just going to stick with what I've got, which is to stay hunkered down. We went over this a lot last week. Yield curve going into a period where it's going to cap gains. It's going to be hard for this market to rally. It's going to be hard for it to drop too, by the way, but still, nonetheless, it's going to be hard for it to rally, and this is one of the reasons why. The yield curve moving flatter and flatter, but not turning negative, is certainly a way that we're going to see this market be capped. Asset allocation remains bearish for the market. People don't want to invest in stocks. They want to invest in bonds. And so we're seeing money flow out of the stock market and into the bond market. Risk appetite also quite negative here, continuing to hunker down. They're saying, hey, you know what? We don't want to get into that risky technology or biotech or retailers. No. Let's just go buy some utilities, some consumer staples, something really, really boring. But at least we won't get hurt bad. So if that's what the market wants to do, that's what we've got to do too. Now, global shares were hit, as you can see, very hard by Brexit. They actually were making new high close for the last, I think, year or so. And then the next day, it all fell out of bed and we started making lower lows. And you can see that the post-Brexit rally has been not that great. Bonds, on the other hand, have been great. Look at that new high up here. This is strong price action, and we've got to be long. You've got to be long bonds here, any kind of fixed income. Yeah, I know there's no yield at all, but there's capital gains. Bonds are about one of the most profitable sectors in the stock market, bond funds, so far this year, and we're halfway through the year, up something like 25%. Our key factors suggest higher interest rates, but there's only one factor that matters right now, and that's the German 10-year interest rates, which is the blue line, and it's plunging to new low yields, so therefore our Treasury notes must do the same thing. The dollar, we've got a little choppy flag formation here. I think we're going to move higher. I'm not wildly bullish, but interest rate differentials between the U.S. and other currencies are very strongly and positively in favor of the U.S. So you can make about a dollar, 1.3%, whereas a D-mark is 0 and a yen is minus 20. So this is where you want to be putting your money. This is where you want to be putting your attention, is on the dollar to the long side. Not a big position. This is not that kind of a situation. The entry rules would be quite easy to follow. You see, we've made a little flag formation over the last week and a half, a break to the upside of that flag formation, and I'd want to be long. Gold. Gotta love this. We've been highlighting gold for some time. Been kind of back and forth, but generally bullish. We had a nice breakout on the Brexit extravaganza, so that was good. Then we set back to the breakout level. That was good. And now we've just made a new high close. That's excellent. So be long gold. Look at Yamana Gold, AUY. Look at Rand Gold, RGLD. Look at GDXJ, GDX. All great ways to be playing the gold market right now. Oh, and by the way, silver market too. But our gold indicators are a mixed bag. A little bit bullish, but that's about all I can say. Certainly not wildly bullish. And so as a result, we're not going to look for this market to explode to the upside. We're not going to rally $1,000. We're going to chug higher. And in a market where chugging higher is dramatically outperforming the market, I think we'll do it. Now, I got a little bit of a change in attitude on oil. So I talked about the big failure top last week, and I talked about how we were going to move into a bear move. And we did exactly that, exactly as predicted. And the market, in fact, did go down. But take a look at what really happened. It went down, and then it rallied right back up again. And I think what's happening is we're really still in that big bull market. We've just put in a little consolidating flag formation. A break above $50 would suggest to me that we're going to head up to about $55, which would be new highs on the whole move. So I'm going to switch to a little bit more of a bullish stance until the market tells us otherwise. All right, everybody, freebies. I know you just enjoyed what you just heard. I know that I've guided you through the Brexit thing, and you hardly got scathed at all. So why don't you step up to the plate and subscribe to the paid-for version and get some super cool stock and options recommendations. And instead of having a Starbucks coffee, why don't you make a bunch of money instead? Sound good? All right. Go to the website up at the very top of the screen, bit.ly/weekly market forecast with a capital W, M, and F, and subscribe. It's quick, it's easy, it's painless. We even give you Novocaine before you subscribe, so it's painless. All right, everybody, thanks very much, all you freebies and fully paid up members. Hang on. I got a lot of new trades here because of the change in the marketplace and because we're in a market of stocks, not a stock market. So freebies, thanks very much. See you next week. Fully paid up members, hang in there for more exciting trades. Bye-bye.